Hello everyone, we are from Group 4. We will present about current value and general price level accounting. And this is our group member.
General price level adjusted historical cost accounting. This type of accounting is characterized primarily by four aspects. First, the use of historical cost as the attribute of the elements of financial statements. Second, the use of general purchasing power as the unit of measure. Third, the matching principle. And the last one, the realization principle. Accordingly, it is the difference between realized revenues and her corresponding historical cost, both expressed in units of general purchasing power.
So the next is general price level adjusted historical cost financial statement. The data contains error in the timing of recording or timing errors, but doesn't indicate errors in the use of unit measurement or measuring unit error. Remains reliability interpretable and only provides a relevant measure of the cost of goods or COG for items that are cash and monetary instruments such as assets and liabilities expressed on monetary units.
Treatment of the general price level gain or loss. There is a lack of consensus among experts and accounting bodies regarding the appropriate treatment of gains or losses arising from change in the general price level. Some approach, such as those found in Accounting Research Study No. 6, APB Settlement No. 3, and the exposure draft issued by the FASB and the CECA, argue that such gain or losses should be included in current income. This view holds that change in the purchasing power due to price level fluctuation directly affect a company's financial performance and should therefore be reflected in the income statement. And on the other hand, there are alternative views suggesting that general price level gains and losses should not affect current earnings but rather be recorded as capital items. This perspective considers that change as long-term and structural in nature, thus more appropriately reported in the equity section of the financial statement.
Treatment of the general price level gain or loss. Number 4, both the general price level gain and loss should be included in current income, with the exception of gains and losses related to long-term debt which should not appear until they are realized through the redemption of the bonds. Number 5, all price level gains and losses should be included in current income, with the exception of gains and losses that arise from including monetary items in shareholders' equity. For example, preferred shares having monetary characteristic. As a general rule, all price level gains or losses are recognized in the general price level income statement.
Now, in this material, we will talk about non-monetary items. Non-monetary items are assets and liabilities that are not expressed in fixed monetary units such as land, buildings, equipment, and inventory, because their value can change due to inflation. These items need to be restated in current purchasing power. This process is done by multiplying the historical value of the item by a conversion factor, which is the ratio between the current year's price index and the index when the item was acquired. The goal is to ensure that the information in the financial statement remains accurate and reflects the relevant economic value, not just the past nominal value that has been eroded by inflation. The formula is conversion factors equal current year index per index when non-monetary item was acquired. Then the historical value is multiplied by the conversion factor. I will give you the example. For the example, a machine was purchased in 2018 for 100 million. The price index in that year is 120 and the price index in 2025 is 180. So the conversion factor is 180 per 120, which mean equal to 1.5. So the current value of the machine in current purchasing power unit is 100 million multiplied by 1.5, which is 150 million. That is the value of the machine that is adjusted to reflect the current purchasing power. And the next material is shareholders' equity. Shareholders' equity is also considered a non-monetary item. Therefore, the adjustment follows the same method, which is multiplying the historical amount of capital by the conversion factor. This adjustment provides a clearer picture of the owner's contribution in the current purchasing power value, not just the nominal value when the investment was made. This restatement helps maintain the consistency and relevance of financial statements, especially when used to assess a company's performance and net worth amid general price fluctuation. The formula is adjusted capital equal current year index per index when capital was invested. And for the example, if the initial capital of 200 million is invested in 2015 with an index of 100 and the index in 2025 is 180, conversion factor is 180 per 100, which is 1.8. The adjusted capital is 200 million multiplied by 1.8, which is 360 million. So the paid in capital is now equivalent to that in purchasing power value in 2025. The next material is retained earnings. Retained earnings cannot be adjusted by a single factor because it's the result of the accumulation of net income during the company's operational period minus dividends. In the first presentation of adjusted financial statements, retained earnings are determined as the remainder after all other accountants or accounts are adjusted. In subsequent periods, retained earnings are adjusted based on net income in current purchasing power units, gains or losses from general price difference on non-monetary items and equity, and adjustment for general price change on monetary items. With this method, retained earnings can reflect the company's real performance in current economic value, not just nominal figures. And the next one, the monetary non-monetary distinction. It's important to distinguish between monetary and non-monetary items because they are treated differently in inflation accounting. The first one, monetary item. Cash, receivable, payables are already recorded at the end of period nominal value, so they do not need to be adjusted. However, they may experience purchasing power gains or losses due to inflation. The second, non-monetary items like land, buildings, inventory do not reflect end of period values, so they must be adjusted to current purchasing power units to be relevant. Understanding this distinction is crucial to ensuring that financial statements are not biased by changes in the value of money over time. The next one, general price level accounting versus current value accounting. General price level accounting only adjusts historical value to change in general purchasing power without recognizing any gains or losses. This is conservative and aims to maintain consistency of financial information. While current value accounting, on the other hand, recognizes gains or losses due to changes in assets values. For example, like an increases in land prices is considered a gain. It reflects market value but tends to be more volatile. The distinction reflects two approaches to inflation accounting. GBLA focuses on adjusting historical value, while current value focuses on revaluing based on market value.
Next is monetary items. In accounting, monetary items refers to assets or liabilities that are fixed in amount in a particular unit of currency, such as the dollar, rupiah, or other domestic currency, regardless of specific price change or change in the general price level or inflation or deflation. This definition is formally adopted in various accounting standard statements. The main characteristic of monetary items is that their nominal amount has been determined through contracts or other provision, so their carrying value does not change, although the purchasing power of money may fluctuate. Examples that fall under this category are cash, account receivable, notes receivable, accounts payable, and fixed interest loan. Although conceptually simple, in practice there are several problems in distinguishing between monetary and non-monetary items. First, some assets and liabilities may exhibit mixed characteristics between monetary and non-monetary, making it difficult to be directly classified. For example, prepaid rent or certain derivative instrument can have elements of fixed value but also depend on market factors. Second, the degree of fixity of an item's value can vary. Not all fixed value are permanent. There are items whose value is only fixed for a certain contractual period, after which it may change. Third, The economic or financial environment may change over time. So even if an item is initially classified as monetary, change such as contract renegotiation or exchange rate fluctuation may affect the certainty of the value. Therefore, accountants need to apply professional judgment in classifying assets and liabilities into monetary or non-monetary categories so that the financial statements still reflect the true economic condition. Next is the example of monetary and non-monetary classification. Preferred shares are classified as non-monetary items under IPB statement number 3 because their value is not entirely fixed and depends on certain conditions. However, the FACB exposure draft states that preferred stock carried at its liquidation or redemption price is still considered a monetary item because the preferred shareholders' claim to the company's asset is worth a fixed dollar amount. For deferred income tax, this item is classified as non-monetary because it is considered a cost saving that will reduce future expense rather than a claim in a specific dollar amount. In terms of foreign currency, foreign cash, receivables denomination in foreign currency, and liabilities payable in foreign currency can be viewed as monetary or non-monetary items. If they are treated as commodities, they are non-monetary items because the price of commodities may fluctuate. However, if they are treated as equivalent to domestic currency items, they are considered monetary items. A more logical approach classifies foreign currency items as monetary if they are stated at closing rates in historical cost-based financial statement and as non-monetary if they are stated as historical rates. For long-term debt denominated in foreign currencies, the classification also depends on how the exchange rate is used. If valued at the closing rate, it is categorized as a monetary item, while if the historical rate is used, it is considered non-monetary. As for convertible debt, this instrument has mixed characteristics. Accounting Research Study number 6 proposed that convertible debt be classified as a monetary item when the market price of the shares is lower than the conversion price, and as a non-monetary item if the market price of the shares is equal to or higher than the conversion price. An alternative view is that convertible bonds should continue to be treated as monetary debt and obligation to pay a fixed amount of money until they are actually converted into shares.
A price level index is used to measure the general change in the price level over time and serves as a tool to assess the extent to which the purchasing power of money has changed due to inflation or deflation. In accounting, this index is important because the historical recording system doesn't take into account changes in the value of money. By applying price indices, financial statements can be adjusted to reflect the real value of assets and liabilities in uniform units of purchasing power at the end of the period. And two commonly used indices are CPI and the GNP. The CPI measures changes in the prices of goods and services commonly consumed by households but tends to have an upward bias as it doesn't take into account changes in consumption patterns. Meanwhile, the GNP reflects the prices of the entire national output and uses arbitrary weights but may provide a downward bias as it includes non-consumption elements such as government spending.
General Price Level Accounting or GPLA. General Price Level Accounting is a method used in accounting to adjust financial statement for the effect of inflation or deflation. It aims to maintain the purchasing power of financial information over time by resetting historical cost figures in terms of a common price level, typically using a general price level index, such as the Customer Price Index or CPE. I'm sorry. Why is the why is this neat? So this is neat because the traditional historical cost accounting assume the value of money remains constant over time. However, in reality, inflation causes the value of money decrease and deflation causes it to increase. As a result, financial statements prepared under historical cost may misrepresent the real economic value of assets, liabilities, income, and expense over time. To address this, GBLA covers all monetary amounts to constant dollars that have the same purchasing power as money at a chosen base date. Argument in favor of general price level accounting. Financial statements that are not adjusted for change in the general price level report assets and claims in dollars with different purchasing power, making the information less accurate and harder to compare. Historical cost accounting often misstates revenue by matching income and expenses from different periods without considering inflation. So, general price level accounting solves this by restating all amount in constant purchasing power using a general price index like the CPE. It's relatively easy to apply and provide more relevant and meaningful information for management and financial statement users. This results in financial reports that better reflect the company's true economic position. Argument against general price level accounting. Argument against general price level accounting include concern about its limited usefulness. Many studies show that link between general price level information and decision making is weak or not widely accepted. This method only reflects overall inflation and ignores specific price changes that affect different industries or film differently. As a result, it may not provide accuracy insight for all business. Additionally, the cost and effort to implement this system may outweigh the potential benefits, especially in environments with low inflation. So that's all the material presented by us. Thank you for your attention and wassalamualaikum warahmatullahi wabarakatuh.